Hi folks, David Waring here with InformedTrades.com. Today we're going to talk a little bit about two different ways that traders look at the market, and this is sort of a basic lesson for people who are brand new to things. If you're more experienced, you can probably skip over this one. The two ways that traders tend to look at the market is referred to as fundamental analysis and technical analysis. Okay? Fundamental analysis is basically looking at all the data that's available outside of price action for a particular financial instrument and then trying to determine whether that financial instrument is over or undervalued or correctly valued based on the analysis run on that data. So a trader or an investor that focuses on fundamental analysis will look at things like the balance sheet of a particular company is a great example. Interest rates for currencies is a great example of a fundamental factor that drives prices there. And they'll look at these things and they'll try and anticipate where price is going to move or where things are under or overvalued based on these fundamental factors. Technical traders, on the other hand, are those that use technical analysis, throw all that stuff to the side and tend to focus purely on price action, okay, or more specifically focus purely on historical price action and looking at and running analysis on historical price action to try and determine what is going to happen with future price action. So the tool of a technical trader is a chart and looking at prices of particular financial instruments and trying to determine whether they're under or overvalued or which direction they're going to move next based on that historical price action. As a general rule, fundamental people or traders, investors tend to be more long-term in nature. A great example is Warren Buffett, as somebody who leans more towards the fundamental side. Technical traders, as a general rule, there are exceptions to both, tend to be more short-term in nature in terms of the lengths of time of their trades. As Informed Trades is a site that focuses on the active trader, we tend to lean a little more towards the technical side of things, and our client base tends to have, or our reader base tends to be a little more technically oriented, so that's where the focus of the next lessons is going to be. So this is kind of meant to give you an overview, just a quick overview of the two different types of analysis. In the next lesson, we're going to look at something called Dow theory, which kind of forms the basis of technical analysis and the foundation of technical analysis, as well as some of the history that goes into that, so we can start to build and knowledge and understanding of technicals, and then eventually build into placing trades using technical analysis. So thanks a lot for watching, and I hope to see you in the next lesson, and have a great day. Hi folks, David Waring here again with InformedTrades.com. In yesterday's lesson we took a look into technical analysis and took a little very brief look into the different ways that traders analyze the markets. In today's lesson we're going to take a short look into the history of technical analysis and something which is known as Dow theory. Most consider the father of technical analysis to be Charles Dow, founder of Dow Jones and Company, which of course publishes the Wall Street Journal. Around 1900, Dow was analyzing the movements of the Dow Jones Industrial Average and the Dow Jones Transportation Index, and he noticed that these two indexes tend to move in predictable ways over time, or similar ways over time. And he outlined his findings in a series of papers which were expanded upon by other traders in the years that follow, and these papers became known as Dow theory. Although Dow theory was written over 100 years ago, most of the basic principles which are outlined in those papers, most traders feel are still relevant today. Also, although Dow focused his work on the Dow Jones Industrial Average and the Dow Jones Transportation Index, most traders also feel that these basic principles are also relevant to any market, not just the stock market, and in particular those indexes. So in today's lesson, we're going to take a look at the first three tenets of Dow theory. There's 6 of them. And then we're going to finish up our conversation on Dow theory in tomorrow's lesson by looking at the last 3. Okay, so let's get started.
Okay, so the first tenet of Dow theory is that the markets have 3 trends. The first type of trend that Dow defined was what's known as an uptrend. You can see an example of an uptrend there, or a time when successive rallies in the security price close at levels higher than those achieved in previous rallies, and when lows occur at levels higher than previous lows, is how Dow defined that. Opposite of an uptrend is a downtrend, which is the second type of trend, and that's basically defined as when a market makes successive lower lows and lower highs. Pretty basic there. The next type of trend is a correction, and basically Dow defined this as a move after the market makes a move sharply in one direction, then the market recedes in the opposite direction before continuing in its original direction. So you can see here, market in an uptrend, then a correction, and then continuation of the original uptrend. It's a good example of a correction there. Tenet 2 is that trends have three phases, and probably the best example of this is a longer term chart of the NASDAQ, and showing in the run up into 2000. You can see the accumulation phase here, which is the first phase, and when the expert traders, so to speak, are actively taking positions which are against the majority of traders. And then the next phase being the public participation phase, where the public at large catches on to what the experts, so to speak, know, and begin trading in the same direction. A lot of times you see a pretty rapid price increase during this time. And then the last phase being the excess phase, and this is where rampant speculation catches on, and basically the smart money people, so to speak, start exiting their trades before the eventual reversal of the trend. You can see that there, and it's a good example of the NASDAQ at the excess phase. If you remember, people were just at the end of the trend, were basically buying just in the hopes of selling to someone else at a higher price. Tenet 3 is that the markets discount all news, and this basically means that once news is released, it's already reflected it's reflected very quickly in the price of an asset. So you can't, what Dow is saying here is, you can't really beat the market by looking at fundamental factors, only by technical factors. And this is in line with the efficient market hypothesis, which is listed there, and technicians or people that use technical analysis often use this as an argument in favor of their type of analysis, because if this is true, the efficient market hypothesis is true, then that really means you can't beat the market using fundamental analysis, so technical analysis would be the only way that you could. So that's our lesson for today. Hopefully you have a good understanding of the first three tenets of Dow theory, and I hope you join us tomorrow for the second three tenets, which we're going to go over in lesson 3. As always, if you have any questions, please feel free to visit us at informedtrades.com or email me at david@informedtrades.com, and have a great day.